Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence. Bond markets are very interesting. Generally, there is a display of volatility in equities, sometimes in currencies, but when the bond markets start moving, that's when you know things are getting real. Now, there is a symptom which the US bond market has been flashing, and that's the rising yields. To give you a context, since September 18th, the Fed has lowered its rates by 1%, but when it comes to bonds, the 10-year yield is almost 1% higher than the levels traded at the time of the first rate cut by the Fed. Good morning, JK. Very interesting times for the fixed income security holder. How are you reading these moves and what triggered yesterday's move higher in bonds?
Good morning, Swaraj. I think for me, the move in the bond market is really concerning uh, because we are actually seeing a big rise in the long-term yields where the Fed is actually, sorry, the Treasury is looking to borrow more to meet their, high deficits and also to roll over as much as $9 trillion this year. So the every basis point that the yield moves, it puts a further upward pressure on the deficit, and we are definitely moving towards 5% in the 30-year very soon. And in the 10-year also, many people do expect the yields to move towards 5%. This may probably happen after we have the Trump's immigration and tariff policies and also the lower taxes being announced. That's the reason why the market is actually not very enthused about buying the dollar, despite these move up in yields. If you look at the dollar index, it is still in the midway between the high that was seen uh, last week and the low that was seen after the Washington Post story about tariffs being pared back only to the essential commodities or essential imports by US. So I'm reminded of September 22, faced with high deficit and huge borrowing. The UK faced big turmoil in the uh, bond market, and which actually had a contagion effect on other markets as well. And so the list stress moment, the infamously called event, is in the minds of bond traders, and I am very much conscious of a similar thing, because we are talking of a much larger economy compared to UK, with the 37 trillion of debt and their fiscal deficit over 6.25%. So yes, the trigger, of course, was yesterday the strong data from ISM Services that came at 54.1, beating the forecast and beating previous month's 52.1. And the real big surprise was the jump in prices paid to an 11-month high of 64.4 from 58.2. Apart from that, the JOLTS data, one of the first indicators about the job market this month, also showed much higher job openings than was forecast. And of course, it also saw a revision in October number. The quits rate was also lower, which means that, the the employees held on to their jobs, and the what was seen, of course, was some lower hirings, which might be kind of seen somewhat negative. Employers getting a bit more cautious about employing new people, but the both the data together actually pushed up the yields to their new cycle highs. In fact, if you look at both the 30-year and 10-year, they have moved more than 50 basis points from the low that was seen in December. And in the meantime, we have had a Fed rate cut as well. Now, following the data, rate futures have priced in a 95% chance of a pause in the January meeting by the Fed. And, also, overall rate cuts this year is down to 37 basis points being forecast, and Fed had indicated two rate cuts. Now we just have to see how this goes about in the coming months. Also, not helping the bond market was the inflation number from Germany, which we yesterday reported at a higher than expected. Eurozone inflation came as expected, but the underlying services inflation was much higher, and the outlook is that inflation will be higher because the subsidy that the government had been giving on the energy prices is not going to be a factor anymore. So the prices will reflect the actual market levels of the energy prices. So we have seen even the yields in UK go up by nearly say 55 basis points, and that in Germany, the benchmark euro bond also going up by 30 basis points. So there is all round buying, rather all round selling of bonds, and increase in the yields. Not to be left behind, even the Japanese yields are at a multi-year high at 1.13% for the 10-year. So I keep an eye on the bond market definitely, which can be at least the first big event that we should look forward to in the year. How this will come down, what measure that the government will take, or whether it is going to create a turmoil like it did in 2022. That's what I'm looking at. But just to point out a completely different world. Swiss inflation came at 0.5%, and they are going to cut another 0.25%, bringing down the official rate to 0.25%. And some people are not ruling out a 0% interest in Swiss economy as well. So as I said, dollar did not gain much, as much as one would have expected with these movement in yields and the strong data. This because the market is observing how the bond market will pan out in the coming days. Of course, the Chinese yuan also surprisingly did not weaken more than what was already seen on Monday. Important to point out that there is a triple top, multi-year triple top at 7.3435 levels in the onshore yuan, which may be holding for some time, and any break will only require a big news on tariff, or a reversal would require some sort of a change in the policy or a different policy that the US government might say. There is a sense in the market that while Trump has denied the Washington Post story about tariffs being limited, I think the market believes that there is no smoke without fire. So some sort of a moderation in the tariff policy may be on. Yen is very interesting because it is pushing against 158, and the Bank of Japan officials are closely monitoring and making several statements. And another intervention threat is not ruled out, as it is much closer to the high of 162 that was seen last year when there was a huge intervention from the Bank of Japan as well. So the dollar is definitely at a very big inflection point. We just see how I think a lot of cues will be taken from the bond market performance. On the Indian side, Rupee had some rare strength, helped by dollar, which had fallen on Monday evening, and Rupee also got some help. Of course, some inflows from corporate bond issuances also was talked about in the market. But as one would expect, the dip to 85.65 was latched onto by the importers, and we even heard the PSU banks coming in and buying the dollar on the dip. Now on the Indian side, we also had a growth survey for 2024-25 fiscal year. Preliminary survey shows 6.4% as against 8.2% that was shown for last year. 8.2%, of course, was above trend growth, and that was not sustained. But important to see that the Q2 of this fiscal year, we are already seeing a big fall of GDP to 5.4%, and there is a sense that a lot of slowdown is seen across many sectors. only agriculture is seen rising, and manufacturing expected to be the hit by the slowest growth, dropping from 9.9% to 5.3%. Being preliminary estimate, we can see a lot of revisions going forward. Therefore, there may not be much reaction from the market, but I will definitely look out for the stock market reaction to this, where FIs continue to be selling. So on the rupee, we are back towards 85.80, and I think overall currencies are going to now consolidate ahead of the January 20 inauguration date of Trump government, and also the how the bond market performs going forward. Thank you.
Thank you, JK. And it definitely seems to be a very exciting time for the markets. We have a major event coming up, but at the same time, what is the precursor? We are seeing a rising yields, especially in the US, and not just in US actually, even in other European countries like EU and Great Britain. So various reasons why the US yields are rising, as JK mentioned, because one factor is, of course, as the debt swells, the Treasury is also planning to raise more money, and those are going to be using the long-term papers. So these issuances also create upward pressure for the yields. Adding to that, the uncertainty of the President-elect Trump's tariff policies and possibly inflationary policies create a supportive environment for higher yields. What triggered yesterday's moves was the strong ISM Services data, jump in the prices paid, along with strong job openings data and lower quits rate. This emphasized on the US exceptionalism narrative that has been going on, and these pushed the yields higher to new cycle highs. When it comes to rate cut probabilities, markets are pricing a pause in January, and for the entire year, the total rate cut probability stand at 37 basis points. Now, the Fed had projected two rate cuts in its dot plots. Swiss inflation came at 0.5%, and that's something that stood out. There are markets are pricing more rate cuts by the S&P. And when it comes to the rupee, we saw some strength yesterday, helped by the broad dollar weakness seen earlier. Dip to 85.65 was held, fueling dollar demand from PSUs and importers. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.